Corporate finance practice problem using OneNote. Residual claims to earnings calculation. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon left-hand side, Practice Problems tab, then down in the 1711 Residual Claims to Earnings tab. Also note, when using OneNote, look at the Immersive Reader tool. Our practice problems will be mirrored in the text area, same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we have our information up top, calculations on down below. Quick calculation here for the residual claims to earnings. So we have the earnings, then we have the paid interest to bondholders, and then the paid dividends to preferred stockholders. So what we're going to do is just think about who gets paid first in essence with regards to the earnings. So generally, if we got the earnings up top of the $20,000, we'd first have to pay off the bondholders as kind of the general rule, and that would be the $6,000. We'd then have to be paying off the preferred stockholders, generally the $4,000. Then we have the residual claims to earnings, which you can generally think of as going to then the shareholders, which are basically the owners of the company, either through the distribution of dividends, meaning they get the distribution of those residual earnings, or they invested back in the company, in which case the equity would go up, and you would think that would be reflected then in the stock price as the value of the company goes up. So this calculation kind of emphasizes who gets paid first. So note that if you had a situation where things were going not well, then, or if there was a bankruptcy or something like that, and you take the earnings, then typically the earnings would first go to the bondholders. They would be better off in that situation, in the situation of like a downturn of some kind. And then generally the preferred stockholders, that's kind of what it means to be preferred. Generally they'll get paid first. And then the residual earnings going to the shareholders would not look as good in that situation. However, of course, if the situation was the other way around, meaning as the earnings go up, then the amount that goes to the bondholders will basically remain the same. We're not going to pay them no more. They're not going to get a bonus as the earnings go up. What they do have is risk protection if the earnings were then to go down. And the dividends for the preferred stock are similar in nature in that in times of good times, they don't usually get a bonus, depends on the terms, but not usually going to have more given to them, but they do have that safeguard against having less basically given to them, right? And then you've got the common stockholders who would benefit as the earnings then go up. So when you think about this type of situation, and this is kind of why you'd want a balanced type of portfolio, because if there's a downturn and you have investments in bonds, then the theory would be that you would get paid first in that situation, and that's hedging against the idea or a situation where there was good times. And if things go up, then you're going to want to have some portion in the common stocks so that you take advantage of the increase in the good times as they happen as well. And this could be easily seen a little bit easier if you look at just a sole proprietorship. If you were to look at a sole proprietorship, then of course you might take out liabilities, say with a bank, and be paying the bank some type of fixed rate. If things went bad and you went bankrupt, then you would have to pay off the bank before you keep any of the residual value. You got to pay off the liabilities in general and then keep the rest. Obviously, if times went well, you would still pay off the bank, again, not give them a bonus. They're not going to get any added amount. You'd pay them off, and then you get the rest of the increase over and above that amount would be the benefit to the sole proprietorship. It's a little bit more difficult to see that when you're talking about a corporation, especially if you're like an investor or, even if you're in the corporation as a manager, to see it as because you're kind of in the middle of a large thing, right? But it's the same kind of concept. If you were investing as a stockholder, then of course you're basically the owner of the corporation in a time of bad times. When times go down, if there was a bankruptcy or something like that, the corporation would typically have to pay off the liabilities first, which would be the bondholders. They would have the general first claim in that situation, and then they would be paying off, say, the preferred stock, and then the common stocks would be at the end of the line in that case. But if times go well, which is of course why you invested in them in the first place, hoping that they would be increasing their earnings, then they'll pay off the bondholders whatever rate was agreed to, the preferred stock at whatever rate was agreed to, and once again the benefits for the residual value would then typically go to the owner in some way, shape, or form, either in distribution in the form of dividends or in the increase in the value of the equity, which you would think would be reflected in the price of the stock.